The financial world woke up to a reality that many dismissed as a fringe fantasy only 12 months ago. Silver has not just moved, it has exploded. As of December 2025, the metal has shattered the $75 per ounce resistance level with a force that has left institutional bears in a state of absolute paralysis. This is not a holiday season anomaly. This is not a low-volume spike driven by algorithmic noise. What we are witnessing is the violent snapping of a coiled spring that has been building structural pressure for over a decade. For most of 2024, silver was a forgotten asset, grinding through the $20 and $30 ranges while technology stocks and cryptocurrencies captured every headline. But underneath that quiet surface, the tectonic plates of the global economy were shifting. The breach of $75 is a definitive signal that the era of cheap, abundant silver is officially over. We are entering a phase of price discovery that defies traditional valuation models. If you have been tracking precious metals as long as I have, you know that silver is often referred to as the devil's metal because of its volatility. However, this move feels different. It is professional, it is sustained, and it is backed by a convergence of forces that we have never seen aligned in this specific way before. We are talking about the complete exhaustion of physical inventories combined with a sudden, desperate pivot by the world's most powerful hedge funds. The question is no longer whether silver is overbought. The question is how high the ceiling goes when the world realized that the silver required for the modern world simply does not exist at these prices. To understand why $75 is just the beginning, we must look at the battlefield of the COMEX. The data coming out of the exchange is nothing short of historic. Open interest has expanded by 18% over the last 12 months, reaching approximately 165,000 contracts. In a typical fake-out rally, you see open interest collapse as traders take quick profits. But here, participation is growing as the price climbs. This means new heavy capital is entering the fray, betting that the current prices are still a bargain. The most shocking transformation is found in the managed money category of the CFTC reports. These are the aggressive hedge funds and commodity trading advisors who typically dictate short-term price direction. Earlier this year, these players were sitting on massive net short positions, betting that a global slowdown would crush industrial demand. They were wrong. As silver crossed the $50, $60, and then $70 marks, these institutions were forced into a catastrophic short squeeze. By late November, they had flipped to a net long position of 28,000 contracts. They are no longer fighting the trend. They are now chasing it with a sense of urgency that borders on panic. The physical pressure is even more telling. Registered silver inventories at the COMEX and London vaults are screaming tightness. Total deliveries for this year have surpassed 14,000 tons. We are seeing a phenomenon where bullion banks can no longer satisfy their obligations by simply moving paper certificates around. They are being forced to find physical metal in a market where there are no large sellers left. When the entities that are supposed to provide liquidity start struggling to find bars to deliver, you are not just looking at a bull market. You are looking at a fundamental breakdown of the fractional reserve pricing system for precious metals. The shorts are not just losing money, they are running out of time. While the paper markets are in chaos, the real story is being written in the factories and research labs of the world. Silver is no longer just a financial asset, it has become the most critical industrial commodity of the 21st century. We are witnessing a massive transition where silver demand has become completely inelastic. This means that companies must buy silver regardless of whether it costs $30 or $100 because there is simply no substitute for its unique electrical and thermal conductivity. Let us look at the three pillars driving this consumption. First, the solar energy revolution. The Solar Power Europe Association estimates that photovoltaic demand alone will consume over 100 million ounces of silver annually by the end of 2025. That represents roughly 12% of total global production dedicated to a single industry. Every solar panel installed on a roof or a massive utility farm requires high-quality silver paste to function. As the world pushes for carbon neutrality, this demand is not just growing, it is accelerating. Second, the transition to electric vehicles. A standard internal combustion engine vehicle uses about 15 to 28 grams of silver. In contrast, an electric vehicle requires between 25 and 50 grams. With global EV adoption scaling toward tens of millions of units annually, The automotive sector is now a massive, permanent sink for silver supply. Finally, we have the rise of artificial intelligence. AI data centers are energy-intensive giants that require massive amounts of silver for their cooling systems, circuit boards, and advanced power distribution networks. Every time a new AI model is trained, more silver is effectively locked into the global technological infrastructure. We are moving from an era where silver was recycled from jewelry to an era where it is consumed by machines and buried in landfills within complex electronics. The most dangerous part of the silver equation for those who are short is the supply side. The world has hit a literal wall. Global mine production has been stagnant for years, hovering around 800 million ounces annually. Unlike software or fiat currency, you cannot simply print more silver. Bringing a new silver mine from discovery to full production takes between 5 and 10 years. It involves complex environmental permitting, massive capital expenditure, and significant geopolitical risk. Most people do not realize that nearly 70% of silver production is a byproduct of mining for other metals like copper, lead, and zinc. This means that even if the price of silver triples, miners cannot simply flip a switch to produce more. They are limited by the geology of their primary base metal deposits. If the global economy slows down and demand for copper or zinc falls, silver production could actually decrease even as silver prices are skyrocketing. Furthermore, the secondary supply from recycling is failing to keep up. Unlike gold, which is almost always recovered because of its high value, silver is used in such small quantities in millions of individual electronic devices that it is often not economically viable to recycle. Once that silver is used in a circuit board or a solar cell, it is effectively gone from the market for decades. We are facing a structural deficit that has been masked for years by the liquidating of old stockpiles, but those stockpiles are now depleted. We have reached the point where the world is consuming more silver than it produces, and the only way to balance the scale is through a much, much higher price. To understand where we are going, we must look at where we have been. The current move to $75 is historic, but it is not without precedent. If we look back to 1979 and 1980, we saw silver climb from $5 to over $50 in just 18 months. That rally was driven by the Hunt brothers attempting to corner the market amidst rampant inflation and monetary chaos. Today, we do not have two brothers fighting the market. We have thousands of industrial corporations and dozens of central banks doing the same thing. Then, consider 2010 and 2011. Silver surged from $18 to nearly $50 in only 8 months as the world reacted to massive quantitative easing. But here is the critical perspective that most analysts ignore: inflation adjustment. $50 in 1980 does not buy the same amount of goods today as it did 45 years ago. If we adjust that historical peak for the loss of purchasing power in the US dollar, silver would need to reach approximately $170 today just to match its 1980 high. What this tells us is that $75 is not an expensive price. In real terms, silver is still trading at a massive discount compared to previous bull markets. In those past cycles, silver did not move in a straight line. It experienced brutal corrections of 20 or even 30% that shook out the weak hands before continuing its parabolic climb. The hallmark of a true silver bull market is that it goes higher than anyone thinks possible and stays there longer than the bears can remain solvent. We are currently in the league of those legendary runs, but with a fundamental backdrop that is arguably 5 times stronger than what we saw in the past. The narrative of silver is shifting from a mere investment to a matter of national security. This is where the price action becomes truly explosive. Russia has recently made a stunning announcement. They are adding over 4,000 tons of silver to their state reserves this year alone. To put that in perspective, 4,000 tons is not a small diversification. It is a strategic stockpiling of a critical industrial and monetary metal. Russia is treating silver with the same strategic importance they accord to oil, natural gas, and gold. Meanwhile, China is playing an even more aggressive and calculated game. As the world's largest consumer of silver, China has begun implementing export restrictions on the metal. The logic is simple and terrifying for the West. China realized that they need every ounce of silver to maintain their dominance in solar energy and electric vehicle manufacturing. By restricting exports, they are effectively starving the global market to feed their own domestic technological machine. This is the birth of resource nationalism in the precious metals sector. When the two largest geopolitical rivals of the United States start hoarding silver and restricting its flow, it sends a clear signal. Scarcity is real, and it is being weaponized. We are no longer just looking at a supply and demand imbalance. We are looking at a strategic scramble for a material that defines the modern economy. If you cannot get silver, you cannot build a modern military, you cannot transition to green energy, and you cannot lead the AI race. This geopolitical premium is the rocket fuel that will carry silver through $80 and toward the triple-digit mark. The final piece of the puzzle is the macroeconomic environment. Silver is currently benefiting from a perfect storm in the currency markets. The US dollar index has recently fallen below the 98 level, hitting multi-month lows. This decline is not accidental. It is the direct result of the Federal Reserve shifting its stance in late 2025. With interest rate cuts now in full effect and signals of further easing throughout 2026, the opportunity cost of holding silver has vanished. When interest rates are high, investors prefer treasury bills because they pay a yield. But when rates fall and inflation remains sticky, silver becomes a preferred store of value. It is the only asset that functions as both a high-tech industrial commodity and a hard monetary hedge. We are also seeing a massive trend of de-dollarization. Central banks across the global south are diversifying their reserves away from the dollar at a record pace. While they traditionally buy gold, the spillover effect into silver is inevitable. Goldman Sachs has projected that gold could reach $4,900 per ounce as central banks compete with private investors for limited supply. Historically, when gold moves, silver follows with even greater intensity. The gold-to-silver ratio, which had been stretched above 80 earlier this year, is now compressing rapidly into the 60 to 70 range. When this ratio breaks below 50, it typically triggers a vertical move in silver prices. We are currently watching the dollar's dominance erode, and silver is the primary beneficiary of that vacuum. So, how does a serious investor navigate this landscape? We have crossed the $75 threshold, and the next psychological magnets are $80, and then the century mark of $100. These are not just numbers. They are triggers for massive waves of retail FOMO. Once silver hits triple digits, it will become a mainstream news story, and at that point, the largest price gains usually occur in the shortest amount of time. To position for this, you must understand the hierarchy of risk and reward. Physical silver remains the foundation for long-term wealth preservation. Owning the metal outright removes counterparty risk and gives you direct exposure to the physical scarcity we have discussed. For those seeking liquidity and tactical movement, silver ETFs provide an efficient way to trade the volatility. However, the highest potential for leverage lies in the silver mining stocks. Companies like First Majestic, Pan American Silver, and Hecla Mining are essentially options on the silver price. When silver moves 20%, these stocks can move 50 or 60% as their profit margins expand exponentially. In conclusion, we are not just looking at a price rally, we are looking at a fundamental revaluation of one of the world's most important materials. The era of $20 silver is a memory. The era of $75 silver is our current reality. And the era of $100 silver is now visible on the horizon. The choice is yours. You can wait for the mainstream media to tell you to buy when the price is already at its peak, or you can act now while the institutional smart money is still building its positions. This is a generational opportunity. Position yourselves accordingly.